We're good?
We're good. You're live.
Hey everyone, welcome to a masterclass in condo investing. I'm Alex Wilson. Nice to meet you. And we're doing this Facebook Live, so sorry for the delay in getting online. It's a bit of a challenge with the technology, but we finally figured it out. We're good to go now. So welcome everyone in Facebook land. So I want to introduce myself for those that don't know me. My name's Alex Wilson, and I have a brokerage called RE/MAX Wealth Builders Real Estate. I've been selling real estate for 10 years. I've been a top producing agent at RE/MAX Condos Plus since 2013. I'm a diamond selling agent, member of the RE/MAX Hall of Fame, a recipient of the Lifetime Achievement Award, did that at 35. Makes me feel a little old. Graduate Economics and Finance from Wilfrid Laurier University. And as successful I've been in real estate, I've been really successful in investing. And one of my early mentors really helped me gain that success, and I appreciate everything she's taught me, and it allowed me to turn an initial deposit of $39,300 on a pre-construction condo in 2012 into over 8 condos, a triplex in Hamilton, and 22 doors. No, a triplex in Hyde Park, sorry, and 22 doors in Hamilton. So one of the things is, what drives me is I know at the end of the day, there's no pension for me. Everything I do, I have to do, and I have to earn my own money. So I'm always motivated on that. I have no money unless I keep on working. So what kind of investments can I make for success? And that's part of my why. I recently got married. I have a young daughter. I want to make sure that I can be successful moving forward. So you have to ask yourself, what is your why? And the purpose of the seminar is to teach you to build financial freedom and generational wealth for your family. And ask yourself why you want to do that. So I'm gonna jump into some easy facts on Canada. And it's important to know where you're investing in. So in 2017, KPMG ranked us the lowest place to do business in all the G7. Toronto costs are on par with low-cost cities in the US like Atlanta and Tampa. It's a great opportunity here in Toronto. And we have open immigration policies in Canada. Canada wants to admit nearly 1 million immigrants over the next 3 years. We admitted 310,000 in 2018, up from 300,000 in 2017, and that number will rise to 330,000 in 2019, and then 340 in 2020. So what does that mean for you in Toronto? Well, we'll get to that. But I also want to let you know we have the most fundamentally sound banking system in Canada. A lot of the objections sometimes I get is like, Alex, are we going to get a meltdown like the US did during the financial crisis? Well, our mortgages are designed much differently than they are in the US. Our mortgages are safer. A borrower has to repay the mortgage even if they ditch the house. So in the US during the financial crisis, you could just drop your keys off and you don't have to worry about the repayment of the loan on the house. In Canada, that will still follow you. And to show that, we look at the delinquency rate. The delinquency rate in Toronto is just 0.12%. To put that perspective, in the US during the peak, the delinquency rate was 4.9% in 2010. And as of March 2017, that had fallen to 1.1%. We're a fraction of what the delinquency rate is in the US even during its recovery. And Toronto investment condos have the lowest delinquency rate out of all types of mortgages out there, because there is always someone paying your rent. If you have your house and you lose your job, you have to find a way to pay your mortgage. But if you lose your job and you have an investment condo, the tenant in the condo is still going to be paying down your mortgage. So they're very, very safe investments over the long run. So let's talk about Toronto. It's ranked number 7 on the Global Financial Centers Index, and this surprised me. Canada has 3 of the top 25 banks globally measured by market value. That includes Royal Bank, Scotiabank, and TD. I didn't know that. I knew Royal Bank was on there, but I didn't know Scotiabank and TD were. We're the second largest source of mining financing in the world. London, England being number 1, we're number 2. 40% of all of Canada's head offices are in Toronto. The jobs are here in the city. And Toronto's been named the fastest growing tech market in North America. I'm actually doing this presentation in the WeWork space at Yonge and Bloor in Toronto right now. It is full of up and coming startup tech companies. To put this in perspective, from 2015 to 2016, Toronto added 22,500 new technology jobs compared to just over 5,000 for New York and just over 11,000 for San Francisco. Toronto has a total of over 200,000 technology workers, a 32% increase over the last 5 years. And 8% of the workers are in technology. It's massive. So that means when you look at those technology jobs that we have an evolving economy towards the new economy, and the jobs are here and being created. And then now let's look at the number of people we have here, the population. The Census Metropolitan Area of Toronto is home to 6.2 million residents and half of the province's labor force. Business and industry here account for 50% of Ontario's GDP and 20% of Canada's GDP, a total of $304 billion. Why that's important? We're more like a London, England than cities in the US. So to put this in perspective, in the US, New York is only responsible for 7.6% of the GDP for all the United States. In the United States, you have different pockets, economic clusters. You're New York, you're Boston, you're Chicago, you're LA, you're San Francisco, you're Seattle. Then you have different other regional hubs where a large company will open a campus in these smaller states. Well, we're centralized here in Toronto, where I mentioned we have 40% of the head offices, and we're responsible for 20% of Canada's GDP. That means of all the economic activity, 20% of happens in the Greater Toronto Area. We're more like London, England, where it's responsible for 22% of the GDP for all the United Kingdom, with an approximate contribution of $564 billion in 2017. So we're a cluster, we're centralized here in Toronto. So we've talked about the population, 6.2 million people. We have the people, and we have the money and the jobs as well. We're also the most multicultural city in the world. And this is very, very important. Between 2011 and 2016, almost 30% of the immigrants, when we talked about immigration increasing, so that's 356,000 people, made Toronto their new home. And remember, if people are immigrating to Canada, because we're the most multicultural city in the world, that means you're most likely to have friends here, family here, at least someone within your cultural background where you're going to feel comfortable to set up roots. So we're always going to be a big magnet to new immigrants that come to Canada. And that last point, sitting on the largest source of fresh water in the world, this is something that we take for granted. But around the world, water is a scarce resource, and we have an abundance of it here in Toronto. So if you think of economies in the future and the resources of the future as population growth continues, having the largest source of fresh water in the world is a huge advantage. So let's talk about demand. In 20 or 30 years, Toronto will be the third largest metropolitan area in North America, and only Los Angeles and New York will be larger. The Greater Toronto Area is projected to be the fastest growing region of the province, with a total population increasing by 2.8 million to reach 9.2 by 2036. Huge population growth continuing expected in the Greater Toronto Area. And that means we have over 100,000 people coming to the region each year from immigration, migration from other parts of Canada, and people, just natural birth rates, starting families. Where are all these individuals going to live? It means the development industry needs 45 units a year. The development industry needs to complete 45 units a year for a balanced market to develop for all those individuals that are coming into the area. And then let's talk about transient individuals. There's a huge international student population in the Greater Toronto Area, and that's increased by 84% over the last decade. There were over 300,000 international students in Canada in 2016. By 2022, the government wants to increase that number to 450,000. At any given time, there are over 100 international students in the GTA. And to put that in perspective, U of T has over 17,000 international students at its campus. It's a massive number of the student population. 20% of the student population of U of T is international. And that's just not our only institution here in Toronto. We have U of T, Ryerson, York University. Then you get into your colleges, George Brown, Seneca, Humber College. All those colleges are all attracting massive amounts of international students, and all those individuals need somewhere to live. And the individuals that come over, to put in perspective, the international tuition rate is roughly around $23,000 on average in Canada. So the people coming here have money. So not only do they need somewhere to live, they have the money to put them in nice accommodations, and that's going to eat up the supply as well for those individuals that are looking for places that are permanent here. That transient population is eating into that supply. So we've talked about Toronto. Why Toronto? We're the economic capital of Canada. It means we're recession-proof. If there is some sort of downturn, the core of the city is the last area to be impacted and the first area to recover. I have someone in the audience nodding their head. I like that. But that's true. So we have the jobs and we have the population. Even if there's a downturn, we still have people that are going to be moving to Toronto, unlike other areas which are more susceptible. Like I'll put, for example, Sudbury, where I'm originally from, which is typically a mining-based community. So if something happened in the mining community, the price of nickel went down, that means there'd be layoffs on the jobs. That means housing prices would go down. But that also means that rental vacancies are going to go up. That's not the case in Toronto, because even if houses prices go down, people still need somewhere to live. And as long as you have someone paying your rent, you're not going to lose money, because you only lose money if you sell. So never put yourself in a situation where you have to sell at some sort of downturn. And then what I like to say is, where would you rather buy? In England, if you could afford it? Liverpool or London? Well, I buy in London, and you still have the ability to buy in Toronto. I can't afford to buy in London. So let's talk about these 5 items here. These are our government regulations that are impacting our supply, and it's leading to higher prices in real estate. And just give me 1 second here. There you go. You have the green belt. So the green belt is an area over the top of the city of Toronto, and that area, you cannot build on it. So that's an artificial area that's constraining the supply in the city. We have rent controls. So what rent controls are doing is that now we have a 2-tier system of rent. If I'm currently renting a property, and before April 21st, 2017, a landlord could have went to you and said, well, this is market rate, you've been here for a year, you're month to month, I'm going to increase your rent, and there's no limit to what they can increase it to. Now with the rent control, the landlord can no longer do that. So if you're an individual, you're locked into an older rental rate where rental rates have increased. Well, you're not going to leave that rental to go over to the same unit, which is more money. So you're going to stay in that rental unit, and you're going to stay in the unit longer. What that means, if we have less turnover of the rental units, which constrains supply for new individuals coming in, and we have record rents that are coming in, which make it attractive for investors and more demand of individuals buying, and will lead to higher prices. We have the stress test, and what that's done to the condo market is that now it's more difficult to get a mortgage on a freehold house, which is expensive. So I can't get that mortgage on that $1 million plus property. So now I have to move down. I have to move down to the condo market, and I have to end up in that area somewhere between 500 to $1 million. So I'm being pushed down from the top into those condos. Then on the bottom level, that entry-level unit, that raises the bottom, because that's the basis that someone get into. So you have a rush of individuals going to the entry level. So we have the push down from here, and we have the push up from here from pricing wise, which is leading to the 1-bedrooms and the 2-bedroom units. We're seeing a great increase in prices. And then we have a drop off of individuals that can no longer get the mortgage, and those individuals rent. And that makes it more attractive for investors, because vacancy rates are less than 1%, and that means rents are going to go up. And investors like that. That means it makes sense for their investments to maintain. So we have increased demand from all sectors. And we look at our infrastructure. We have horrible infrastructure in the city in regards to public transit wise. And truly, it's all about how we get from point A to point B. There is lots of land in the city of Toronto, but it's not unlocked by transit. So if I can't get from point A to point B, those values are going to be suppressed. So that's where we see massive escalation of prices along the young subway. And other areas we're seeing them depressed wise because I just can't get out of that area to where I need to be, where the jobs are. And I always want to be connected to where the jobs are, and that's downtown Toronto. I want somewhere where I can connect to downtown where I am here. So is there any new transit coming? No. So if they started building the relief line tomorrow, construction would take 8 to 10 years. But you still have a planning process before that. So current city estimates mean that a relief line isn't going to be ready till 2031. And to put that in perspective, the construction of the Line 1 to York began in 2008 and completed nearly 10 years later. So that's what you're looking at. 2031 before we have any real serious relief coming from subway infrastructure. So what does that mean? Focusing on the core, we build up, and prices continue to escalate. So why condos? Well, there's a massive affordability gap between the freehold properties and condos. We're still looking at over a $500,000 gap between the price of condos and freehold houses. We have low vacancy rates, and there's supply issues, even on the condo side. I'm going to go back. I skipped over the removal of the OMB process because it takes a little longer to talk about. But if you're not aware of what the OMB is, it's the Ontario Municipal Board. And what a builder could do is they could appeal to them if they were trying to build a building that made sense for more density and the city wouldn't allow for it. So they could always go to the OMB, and if it made sense, they would get the approval for that density. Now they've removed that appeal process, so builders are dealing directly with the city, which makes it difficult to more people coming in, which makes it difficult for builders to get the density that they need. So what does that mean? It means smaller buildings, and that means less supply, that means higher costs, and as well, because they're dealing at a city level, the red tape is going to increase. That means the time to get a building approval will be longer, which will increase expenses as well, which will lead to higher prices because now we have constrained supply. So all these different government regulation issues are leading to increased prices as well. So we talked about why condos, we talked about the affordability gap, low vacancy. We have a less than 1% vacancy rate here in Toronto. And in regards to supply issues, we talked about the supply issues, the number of buildings that are coming on. We're not making enough properties for the new people to move into. Now they're easy to maintain. What's great about that is that you're just really building a concrete box in the sky. So there's not much that can actually go wrong with a condo where you're dealing with a house. You have the roof, you have a hot water tank can burst. That happened to me recently. You have all these various things that can go wrong with the house. But with a condo, it's just a box in the sky, and you have an on-site manager that's going to be helping with the building. Lower cost to maintain. Liquidity. They're liquid. So what does that mean? If I own 3 properties and I want to get rid of one, I can sell one, I still have 2. If I have a more expensive house, if I want to get rid of the house, but I wanted to maintain the real estate, I can't. I have to sell the whole house, and now I'm out of the real estate game. So the liquidity to it. And you're dealing with 6-figure households and AAA tenant profiles when we're dealing within the core of the city. So that's great. You know you're getting tenants in here that's going to be paying the rent on your properties. So we talked about the affordability gap between freehold and condos. It's difficult probably to see on your screen, but it's been gradually increasing over the years. And as I said, we have an over $500,000 gap between freehold prices and the detached prices and the condo prices. And we talked about Condo lease volumes at records high, but turnover is declining. So what does turnover mean? Turnover means that people are staying in their units longer and they're not coming back on the market. So we see that the average stay has increased to over 22 months. That's what your average tenant stays. Before, if I look at the screen here, we were at 16.4. The time that tenants are staying is increasing. And purpose-built inventory has stalled. So what that means is that builders that actually build apartment buildings, they're not doing that anymore. The amount of those units that are coming online has stalled because it's more profitable for them to build condos. So they're going to keep on building condos so we don't have that new rental inventory, that new purpose-built inventory coming to market. And what does that mean? That means higher rents, and that makes it still attractive for investors, and investors will continue to come to the market because the rents are very attractive to them. And the result? Record low vacancy rate. 0.7% is the vacancy rate in downtown Toronto. Incredibly low vacancy rate here in Toronto. And then our total supply, when we look at resale and new condo product, it's also at record lows. We are at, and we look at the number here, only at 3.4, where the balance market is 13.5. So a huge lack of supply on the market. So let's look at who is living in condos. Millennials, as young workers, flock downtown. These are individuals born in the early 80s to late 90s. Over half the downtown Toronto population is millennial. Where will all these professionals live when they start families? They will need to live in condos, and they will need to live in condos longer. Again, the reason being the freehold property is out of reach. The idea of the white picket fence, that is now gone. They can't afford to buy that freehold property. And it doesn't mean that those freehold properties are going to go down in value, because the supply of freehold properties, it's not even fixed, it's decreasing in Toronto. The reason for that is there's no more land to build freehold properties, and I may have a block of houses that a developer will knock down and put a more dense project on there, which will be condos. So I have a decreasing supply of freehold houses, so my price of houses will always maintain and go up in the long run, but the millennials can't afford that, so they'll live in the condos and live in condos longer. So when is the right time to get in the market? Now, always the right time. And you may laugh at me, but it all starts with one. Everything that I talk about next on how to increase your wealth through condo investment starts by owning one property. You need to own one condo to start growing your wealth. And this is a little slide here. You cannot afford not to buy. So we just did an example. If you bought a $400,000 condo with 5% down, what would that be? What would be in your pocket over a 5-year period? Well, your net profit over a 5-year period with just a compounded appreciation of 3% per year, and with equity paydown, your gain will be $120,000 tax-free over the 5 years for the property that you're living in, your principal residence. If you're renting, how many people you know that could save $120,000 over a 5-year period just saving their money, counting their pennies, and investing? That's a difficult thing to do for a young professional. So you cannot afford not to buy, get into the market, and that'll allow you to participate in growth and equity paydown. So when you're looking at condos, you want to know which future upcoming projects and what good locations are coming up. You want to know about the reputation of the developer. We've seen that in the news lately in regards to canceled projects-wise, getting lots of questions about that. You want to research a location, what is going to be happening in that location, which is going to allow for that building to increase in value, or is there going to be a building that's going to go in front of my building that's going to block my view? And with the building going up, does it make sense for the price per square foot for the area? Am I buying something of value? You want to make sure the rental income for the area matches the size of unit. You want to determine if the rents carry the cost of the unit. We handpick specific units that we want based on satisfying the above criteria when we work with our builders, and we get exclusive access to preferred units for a limited amount of time. So this is more talking about when we deal with the new development process. We get first access to new projects. Developers first release these projects to top producing agents. So I get access to those projects. I liken it to an IPO launch. So an IPO is an initial public offering if I have a company and I'm launching onto the stock market. And if I'm buying in that, I would have to use my bank account and go through some stock trading program and buy it on the open market. But I know that there were people that bought before me at a much lower price point. So what I get in real estate wise, I get like an IPO launch for real estate. I get the first access to these condo projects, which is at the lowest possible price point for individuals. Now, when these projects launch, time is truly of the essence. You're probably looking about a 3-day period to make these decisions. And this is why I do these presentations, because it's very difficult to make a decision. Hey, do you want to buy this $500,000 condo? It takes time for you to wrap your head around that. So we do these seminars to teach people so they can understand the value of investing in real estate. So when those opportunities come up, they're equipped to make that quick buying decision. Options for signing, you're typically signing on the weekend. And if you're traveling, you're an international buyer, you should have a POA in place, a power of attorney. Typically, you're looking at 20% deposits, which are 20% of the purchase price. And those payments are staggered, typically paid out over 1 to 1.5 years. And what it'll be is a $5,000 in signing, a balance of 5% in 30 days, maybe 5% in 60 or 90 days, 5%, nope, my camera guy's saying I'm walking too far away. 5% in, could be 270 days, and maybe another 5% in 365, or maybe 540 days. That's your typical deposit structure. Incentives, sometimes we're able to negotiate extended deposit structures where it's going to be a 15% down or over a longer period. Maybe there'll be a cashback option. Always we look at trying to get a free assignment, and we definitely want capped development fees as well. We offer our clients a review of the new development agreements. Our lawyer does that, and we assist you in getting that mortgage approval letter. So that's the new development condo buying process. And anyone in the room, I'm more than happy to sit down and talk to you more about that after. So now I want to get into leverage versus debt. So a lot of things that I come across is people go, Alex, you're telling me to buy more real estate, that's going to put me more in debt. And it's not debt, it's leverage. Debt is when you use other people's money to purchase non-income making depreciating assets. That's debt. So that's like if you buy a car and you use debt to buy the car, that's an item that's going down in value, and it's not making me any money. Leverage is when you use other people's money to purchase income-making assets. So if I do a line of credit off my home to purchase a piece of real estate, I'm using other people's money, the bank's money, to buy into something that's going to make me money. I'm using leverage to help me get ahead. And we're going to show examples of how I use leverage to get ahead personally. So my success, follow my lead. This here is my real estate portfolio, and this is the success that I've had by investing in real estate. So over the years, buying all these properties, they've continuously gone up in value, and I've done very, very well through these investments wise. So why you want to maximize your portfolio? Oops. If you're looking at your property, equity in your property is dead money. It's great that properties have gone up in value, but you only realize that money if you sell your property, and then you have to go buy something else, and that's just going to be as expensive. So unless you move out of the city and exit this area altogether, you're not going to be able to realize that money unless you look at a leverage opportunity. So use equity, other people's money, to expand your portfolio. And we always want to make sure we're using and paying the right and lowest interest rate. So for example, say you already have that second investment property. Well, in that case, then we want to do a refinance on that investment condo instead of doing a line of credit. You do a line of credit off your house to take that money to help invest, and you can write that interest off because you bought an income-making asset. your investment property is already an income-making asset, so that interest is already tax deductible. So you want to do a refinance, which will provide a lower rate of interest, and then you can use that to continue to advance your portfolio. I'm always looking for the Goldilocks method. I just coined the term, maybe it's out there as well, I don't know. And this is all about cash flow management. So if you have too much positive cash flow, it's all going to get taxed away. You could have increased equity in the property to purchase more investment units. So what I mean by that is, again, if I have that one condo unit, and in 5 years I still have one condo unit, and if I'm making $300 a month from that one condo unit, well, I'm doing okay. But what if I tapped in the equity of the property, decreased my cash flow to a zero cash flow model, and then bought another condo unit? So then at the end of 5 years I have 2 condo units instead of 1. And I'm going to go over an example to show how valuable that is. And then you want too much negative cash flow, it exposes you to risk. If we're not able to maintain our monthly obligations, we put ourselves in a situation where we have to sell. And we never want to put ourselves in the situation where we have to sell. That's when you lose money in real estate. You want to focus on neutral cash flow, which minimizes our taxable rental income and efficiently uses equity by maximizing the number of investment properties we own that are appreciating in value and have their equity paid down. It's like Monopoly. I use my Baltic Avenue, my very first Monopoly piece, to work my way around the board. I don't buy Park Place first, I work my way around the board to get to Park Place. So that's what you want to do with your properties. Use your Baltic Avenue, use that first property to help yourself work around the board, and you literally play real life Monopoly. Okay, so now I wanted to show you how I can turn one condo into 3 condos. And this is a case study. So my first investment condo I bought for $262,400. The current market value in that condo was $500,000. The current mortgage on that condo was $202,000. The market rental rate on that condo is $2,100 per month. So what I can do is I can refinance equity out of that property and reinvest it. So I can get an 80% loan to value from the bank. That means I have $400,000 of refinancing available. That refinance amount, I take that $400,000, I subtract my current mortgage of $202,000, and that allows me a available equity to reinvest of $197,000. So what do? I don't go and put it into, it becomes debt if I take that and I put that into non-appreciating assets. I take that money and I buy more real estate. So what I did is I used that $197,812 to buy 2 pre-construction condos. So in 2016, I bought a condo at 75 the Esplanade, and in 2017, I bought a condo at Canary Block, and those deposits equaled $175,000. The current market value on those, I bought one for $380,000. The current market value of that is $483,000. The other one I bought for $578,000. The current market value of that is $750,000. So my total gain, the difference between that, is $320,000. So to turn the current appreciation of those 2 condos is $320,000. So by using that equity in the first condo and putting in 2 other properties, I gained another $320,000 of appreciation. But if I did nothing, I wouldn't have got that. So now this is where things get crazy. What happens over the next 5 years? So let's assume a conservative 5% annual compounding growth. And to put that in perspective, the average rate of appreciation of the downtown Toronto condos has been 9.4% over the last 5 years. So I take my Canary condo. In 5 years, that'll be worth $638,000. So I less my original mortgage. My gain is $282,000. 75 the Esplanade, by 2023, that's going to be worth $616,000 for another gain of $133,000. And my Canary Block property, its value will be $957,000. That's a gain of another $207,000. So a total gain from 2018 to 2023 is $612,000. So what's the result of me maximizing my portfolio? The leverage equity of one condo, $197,000. Turn that leverage equity into 2 condos. Current appreciation of that is $320,000. Then at the end of the 5 years, at a 5% annual compounded growth rate of those 3 properties, My total gain from leveraging my one condo is $943,000. It sounds crazy, but it happens. Oh, I have a question from the crowd.
Can I ask a question?
Yeah, of course, yeah.
Questions regarding how these two different gains, capital gain versus
Yep.
cash flow income, are tax different?
Yes.
And how would you optimize in order to...
Okay, so the question from the crowd is how do you differentiate what your cash flow, how is that taxed, and your capital gain? So the key thing is, I only realize a capital gain when I'm selling the property, but I'm not selling these properties, I'm letting them sit. Eventually, I'll have to pay tax on them. When I dispose of it, then I'll pay a capital gain. And a capital gain, what the capital gain tax is, I have a 50%, I only pay 50% of the profit and take that into my current taxable income level. My rental income coming in, that gets taxed at 100% of my tax rate, current tax rate. So, but because I'm not selling, I don't have to worry about a tax consequence to the future. I'm in my accumulation phase of my life. Later in life, I may be in my cash flow phase. What I mean by that is, currently I want to accumulate a lot of assets, so I'm using my assets to accumulate more assets. Later on in life, when I don't want to work as hard, I'll be able to live off the cash flow over all my assets. So then, yes, I'll be paying a higher tax rate on those, but I'm okay with that because I'm not working anymore, and I'm going to be reducing my current income levels, and that I'll live off the cash flow of my properties, using other people's money to grow the properties, and then I'm going to live off the properties, just focusing on passive income. And we're going to talk a little bit more about that later. So continuing on the unleveraged portfolio, at the end of 5 years, if I just kept the condo, didn't do any leverage, at the end of 5 years, at 2023, at 5% annual compounded growth, my Carnaby condo will be worth $612,000. When the current market value is $500,000, probably have equity pay down. So what equity pay down is, I have a tenant living in there, they're paying down the mortgage because part of the rent goes to cover interest and the equity pay down. So equity pay down $22,000, and then I'm getting some cash flow as well. So before tax cash flow, probably another $40,000 I'll be getting on the property. So that's a total gain without leverage of $185,000. That's a massive difference in numbers, $185,000 to nearly $1 million by 2023 by leveraging my portfolio. And then we just look at the difference here. So leverage versus unleveraged, total gain over 5 years without leveraging, we talked $185,000. Current gain of leverage portfolio, $320,000. So that's 73% that I've made there. 5-year gain of leverage portfolio, the difference is $437,000 or 236%. Total gain of leverage portfolio altogether, I'm over 400% better than my unleveraged portfolio. And that's just at a 5% conservative annual growth rate. Which portfolio would you prefer? So this is my favorite slide in the whole thing. My whole presentation right here. If there's anything you're going to take away from this, I want you to look at this slide. Real estate is a long and boring game. You may raise your hand going, Alex, what if prices go down? I have no crystal ball. Prices could go down. I have no control over that. But again, you always want to focus on, I only lose money if I sell. So never put yourself in a situation where you have to sell. So that's why at the beginning of my presentation, we talked about Canada and why Canada is a great place. We talked about Toronto, the economic fundamentals of Toronto. We're confident in Toronto. We always know that people will be moving to Toronto. That means there'll always be someone to live in my condo. So even if prices go down, what's my portfolio going to be worth in 30 years? Why use 30 years? We're using 30-year amortizations for our mortgages that we get in properties. That means in 30 years, my portfolio will be completely paid off. So if I was to stop buying right now, what is my portfolio going to be worth in 30 years? I worked out the math. At a conservative 3% compounded annual growth, so just going 3% per year, that's it. My portfolio will be worth over $12 million in 30 years. Now, when we talk about money, there is inflation. So what does that $12 million mean in today's pocket? Because we're all about, let's talk about the real numbers. So I went back 30 years. I said, well, what's what was $12 million worth in 1987? It was worth $6.5 million. So if we just use those past statistical numbers, my current portfolio is worth $6.5 million in today's dollars. If I just did nothing and just let the market continue to go up, may have some bumps along the way, but I always know someone's going to be living in my condo paying down the mortgage. And that's not even factoring in any cash flow, additional cash flow I'm getting from the properties. This is just pure from appreciation of the property and having a tenant paying down the property. It's a long and boring game. Never sell. I don't sell. Now, you may have times during your portfolio where we're managing the portfolio, we're watching it, maybe you're holding for 6, 10 years, you're looking at it going, I don't know how much more this asset is going up in value, but if I took that money out, put it in another real estate asset, a newer condo that may appreciate faster, we may balance our portfolio like a financial planner would do or a financial manager would do. That's how we see ourselves in real estate, your financial manager for your real estate assets. So we're always looking at our values. Maybe there's some times that we should sell off the property to maximize our value before we get a depreciating rate of return. So there will be times you may sell, but you always want to focus on how do I maximize my long-term value, and it's always by buying and holding. So I'm just going to jump on this side quickly. This is for individuals that are more for self-employed. So if you own your own business, it could be beneficial for you to purchase real estate through a holding company. The highest personal tax rate in Ontario is nearly 54%. The small business tax rate is 13.5%. For every $100,000 kept in the corporation, it works out a difference of $40,000. I'd much rather use my corporate dollars to invest in my personal dollars. So what I can do is I can move my money from my operating company to my holding company to purchase real estate. You never want to buy your real estate in your operating company. Banks don't like that. They won't give you mortgages. And you'll purchase the real estate in your holding company's name. Now we have accountants that can help you in developing that structure and see if it makes sense for you, but it's something that you want to look at. If you are self-employed, you can buy things through a holding company and then talk to your accountant or ask me, and I can give you some advice going, does this make sense for me to do? Yes or no, Alex? And I can give you advice on that. And that's a presentation. So open the floor to any questions. Anyone have any questions here? I'd love to answer them. Yeah, there we go. Yeah, cool. Of course.
The calculations you were doing, the
Yep.
3% growth rate
Mm-hmm.
compounded over 30 years.
Yep.
They were, well, you're using leverage, so you're
Yep.
borrowing money or financing.
Mm-hmm.
The calculations are based on fixed interest rates for mortgage or variable?
So all I'm doing, so I kept it really simple. So the question was asking when I was doing my 30-year growth period, asking about interest rates. The interest rate that I'm paying on my mortgage doesn't matter because at the end of 30 years, my mortgage is going to be paid off. I'm making the assumption that my tenant is covering all my costs. That's my assumption. So if interest rates go up, or interest rates go down, it doesn't matter because I have a tenant that's going to be paying those costs. It's just looking at over the long run, and I know in 30 years my mortgage will be paid off because I've had a tenant paying down the mortgage. So the assumption I made there is my tenant covers the costs. So I do not have control, this is for everyone in the crowd, I do not have control over what futures interest rates are, but we don't expect to see a massive increase in interest rates over the short to medium period or long run. How real estate prices go down is if you have a rapid succession of interest rate increases. If you have a gradual increase in interest rates, people will adjust, it'll be okay. But if you have a spike like this, then that's when you're going to see prices go down. We don't expect to see a spike of interest rates. What you need for a spike in interest rates, you need inflation. We're not in any inflation issues here, and we don't foresee any inflation issues going towards in the future. So we don't see any inflation concerns. So yes, they are doing some tightening of monetary policy, but we're only seeing a very, very gradual state. And remember, our economy is still very, very sensitive. It's not like we're roaring. There is sensitivity to the economy, so we don't expect to see a massive increase in interest rates out there. Any other questions out there? Jesse. So this is a question from another real estate agent, so this should be a good one.
So Kitchener's apparently experiencing growth, and transportation going into that area. What are your thoughts on Kitchener?
I went to Wilfrid Laurier University, so I know KW very, very well. The key point is I need connectivity. What's the proximity? How do I get to Toronto? I always want to get to Toronto. Doesn't mean I have to work in Toronto. I just have to have the ability to get to Toronto, because I may not work in Toronto, but at some point, someone that I'm selling the property to may work in Toronto. So I want to make sure that my property allows me to get to Toronto. Kitchener obviously has Wilfrid Laurier University as well as Waterloo University. We always called ourselves the high school down the street. You have Waterloo University, which is a huge hotbed of talent for these tech companies. So we know there's a huge talent bed in Waterloo that's pumping out all these engineers engineers are needed for artificial intelligence. For example, one of the big things that is a massive growing level. So you want to make sure the connectivity is there. You're walking. Everything has to be walking wise. I don't even think I talked about that enough. I always want connectivity, and I want walkability. What I mean by walkability is I want to be able to walk to that form of transit, and I also want to be able to walk to my door and enjoy the community around me. So that's how we evaluate things. We may not always be focusing on the core. There may be other opportunities outside of the core where we see value, but I always want to make sure I have walkability to that area. Okay. Any other questions? Everyone, thank you so much for tuning in online. This will be reposted, so for those people who missed out, you'll be able to see on Facebook. And thank you so much for attending a masterclass in condo investing. Have a good day.